Chances are you have an IRA if you're saving for retirement. It may be a Roth IRA, maybe a SEP IRA, or a traditional IRA. These are powerful accounts, but we want to make sure you know how to avoid costly mistakes and costly taxes and penalties when it comes to getting your money out of these accounts. It's easy to get money in, but are you equipped to get money out wisely? Today, I'm going to dive into how the most successful retirees do this well. Hey everybody, Chris Heerlein here of REAP Financial, host of Wealth Radio on KLBJ and host of Retire Ready TV on KXAN. Thanks for making us part of your day. Be sure to hit the subscribe button. I drop new content every week. Hit the bell for notifications as well. Today I'm talking about how to avoid costly IRA mistakes wisely. And you got to be sure and stick with me to the end of the video because I'm going to make sure I cover the most overlooked item when it comes to big penalties and taxes on these IRAs. Keep it here. Okay, so I've always said it's easier to get money in IRAs than it is out of them, and I'm going to show you why today. But let's talk about getting money in. Here in 2024, we've seen contribution limits go up. It's now $7,000 for all of you watching that are under age 50, and then after you get over age 50, you can do what's called a catch-up contribution. So it's $1,000 extra, so a total of $8,000 for your IRA contribution this year, all you over 50. Now, there's a misconception. They're like, well, I can't do a contribution to a traditional IRA and to a Roth IRA. And that's untrue. You can do a contribution to both, assuming your income isn't above certain limits. And when you do this, you could do half to your traditional IRA, half to your Roth IRA. You could do 100% to one or the other. I really like the idea of blending them because some of the money you're getting a tax deduction on today, some of it you're not, but some of it you'll get tax-free forever. The other dollars in the traditional IRA, well, that'll be taxed forever unless it is converted down the road. So you want some tax diversification in your savings. Another misconception is, can I have a SEP IRA and a traditional IRA? The answer is yes. If you have self-employed income, if you're a consultant, you have 1099 income, you can have a traditional IRA and a SEP IRA, particularly if you have a W-2 job as well. Many people go, well, can I have a 401k in an IRA? Absolutely you can. You could have a 401k through your employer-sponsored plan, and then outside of that plan, in most cases, you can do a IRA or Roth IRA contribution. So don't shortchange yourself on how much you're putting in and where you can put your dollars. Now, when I say it's easier to get money in than it is out, this is why. There's rules around distributions out of your IRAs and Roth IRAs. And the number one magic age when it comes to these accounts is age 59 and a half, okay? Once you hit age 59 and a half, you can then begin distributing dollars out of these accounts without a 10% penalty. If you take money out before, they hit you with a 10% annual or an early withdrawal penalty, plus any taxes due on the distribution if it's out of a traditional IRA. So that's the first thing to consider. So when you're saving wealth through your early years into your later years, liquidity can be a big deal. And so if you've got all of your money in a traditional IRA and you can't touch it until you're 59 and a half, well, things may come up between now and then. So it's good to save in multiple accounts and diversified accounts. But when it comes to a Roth IRA, a little known tactic is the idea that you can actually touch the basis of what you've put into it before age 59 and a half. So I'll give you an example. If you were putting $5,000 a year into your Roth and you did that for 4 years, now you've put $20,000 in. And let's say with growth over the years, it's now worth $25,000 and you needed a liquidity event. You needed cash. Well, let me be clear. The last place I want you going is your Roth and IRAs because that's for future retirement years. But if you absolutely had to, in this case where you had a $25,000 Roth IRA, you could consider taking money out. As long as you didn't touch the gains, you would not be subject to a early withdrawal penalty. Now, there's some 5-year rules when it comes to Roth. The account must be established for at least 5 years before you can take distributions. So I always tell people, hey, Get it established as soon as you can. And then also for your Roth conversions, there's a 5-year rule. So those of you that are in your retirement years or soon to be and you're wanting to get money moved over to a Roth IRA from a 401k or a traditional IRA, there's a 5-year rule on the conversion. I talk about that in several other YouTube videos here on our channel. Be sure and hit the subscribe button to catch those as well. Also, I want to encourage you to go to reapfinancial.com where you can download a number of our free retirement resources. And these are resources that our successful families at Reap Financial utilize day in, day out with their retirement plans. Go to reapfinancial.com. IRAs and Roth IRAs don't offer loans. 401ks at your employer plan, depending on the employer, the plan itself, you may be able to take a 401k loan. And interest is assessed on that just like any loan, and it can be repaid back out of your payroll deductions in future years. So there is some liquidity in 401ks that most of the IRAs don't allow for. So again, this just goes to show why we want to save money in multiple places that give us liquidity. Maybe some don't. Some give us tax-free growth. Some is tax-deferred growth. This is how the most successful retirees do this. Now, a lot of our viewers, you may have more questions than answers around these topics and more. I want to encourage you, put your questions in the comments section below, and that way I can answer it in future videos to come. Now, when it comes to investing and saving, a lot of you may have gotten off the ground just by payroll deductions with your employer plan or putting money away in your bank savings or IRAs. But as your wealth has accumulated, as you're getting closer to retirement and you got substantial assets in your IRAs, 401ks, you may want to consider working with an advisor. An advisor, financial advisor in this case, in our opinion, is the most important hire of your life. And you've got to ensure you're working with a fiduciary. That should be the first question you ask in your interviewing process is, are you a fiduciary? And why? Because a fiduciary legally has to do what's in your best interest. There's suitability advisors, a suitability standard, a standard that many advisors adhere to, and then there's the fiduciary standard. Most people don't know that. But when it comes to advising you on where to place your wealth, invest your wealth, and position your wealth for your future retirement, you want to ensure a fiduciary is working in your best interest. Another way to avoid costly IRA mistakes is just by diversifying. There's two types of diversification I want to talk about here. One is making sure you're diversified in your asset mix. You don't have everything in one stock. You don't have everything in one mutual fund. You want things spread out. You want to position your wealth, particularly those of you in retirement or soon to be. You need to position your wealth in a way that there is zig and zag. You want to make sure when we have a market year that the equity markets, the stock market's down, you've got assets that are going up or not going anywhere in a down market. You want to make sure you're positioned in a way in your equity portfolio that if the market is on a tear, you're seeing meaningful growth in that portion of your portfolio. You want to look at true diversification. True diversification isn't just about the asset you're invested in, it's also about the tax class you're invested in. You need tax diversification. In a costly mistake, it may not have to be something where you withdrew it early or, made a mistake in overfunding it. A costly mistake we see people make is when you have all of your wealth in pre-tax IRAs, even pre-tax 401ks, every dollar of that money is going to be subject to tax. And an IRA is a one-sided relationship with you and the government because they get to dictate how much tax you're going to pay when it's time to pay the piper. And then if you didn't even need the money, our most successful families at Reap Financial, they find themselves in a tax issue when they hit an age of 73 or 75. This is where your required minimum distribution kicks in. And in this case, it can greatly accelerate your bracket. It can launch you up a tax bracket or two. You can see your Medicare premiums go up and a lot more. And I talk about that in many videos here on our channel. So be sure and subscribe. Hit the subscribe button down below as I drop new content every Wednesday. Now make sure and click on the next video where I'm going to talk about how to use your IRA to fund your HSA, your health savings account. There's a little known strategy that the IRS allows you to do once in a lifetime to fund what I call the most powerful retirement account on the planet, your health savings account. Click on that video. We'll see you there.